Today, we're going to talk about bonding basics with Kara Skinner. But before we get started, I'd like to remind everybody to go ahead and edit your name, the three little dots right by up on the top right-hand corner. If you would type in your name and your company, like I am. And that way we'll be able to check you off on the roster. So today we have in the house, we have Lori Fazio from the Clallam Economic Development Council, Andrew Miller from the Northwest Small Business Transportation Resource Center. And I'd like to introduce Lori so she can give us just a few words of welcome. So it's all yours, Lori.
Yes, thank you again. We are so glad that you are all here today, getting ready to learn a little bit more. I'm super excited to learn about the bonding basics myself, Kara. This will be extremely helpful with us here at the Clallam County EDC, and so that we can share this with our partners on what a surety bonding looks like, what it looks like for bonding just in general for our local contractors, so that when they are getting educated here, they have a good basis on what it looks like when they go out to bid for these large government and public opportunities for projects in Clallam County. So once again, thank you all for being on the call. We will probably have more people enter as we move along throughout the class. And so thank you again, everyone else with our partners at Kitsap Bank, PTAC, and Aisha at SBRTC. And so we are super happy. Oh, and MPBA, Amber is not on the call. I did send her an email hoping that she could join for this particular class this morning. So thank you, Kara, and thank you everyone for being on the call.
Well, thank you, Lori. I think you got all the bases covered on all of our partners. And realistically, you know, we could not be here today without some of the heavy lifting by Clallam County EDC and NPBA. And PTAC and SBTRC work together on a lot of projects, so it's always good to have some familiar faces here. So with that, I'd like to introduce to you Kara Skinner, and Kara is with Integrity Surety, and she's the one that knows all about surety bonding. And you know, surety bonding is one of those topics within the construction industry that will be vital moving forward on, you know, contracts, partnerships, relationships, and, you know, just making sure all your T's are crossed and your I's are dotted. So with no further ado, I'd like to introduce Kara Skinner.
Thank you. I appreciate the introduction, and I want to thank everybody for being here. This is actually a lot of fun for me. I used to do this live and in person. So if you want to unmute yourself, make a little noise in the background, have a cat walk across your screen or a dog barking in the background, that will help me feel like I'm not alone up here. My name is Kara Skinner. I'm from Integrity Surety. We're a wholesaler, and we only sell surety bonds. So I like to think of us sort of like a subcontractor. So if you're a contractor, you know that you hire a subcontractor for certain trades so that they're the specialist in that trade. So we are the specialist in surety bonds, and all we do are surety bonds. We don't do any insurance. I won't be talking about insurance today. I will be talking about bonds, and most importantly, I really want this to be beneficial for you. So I think we're a small enough group that I want you to feel like we're having a conversation and ask questions that are relevant to you, because my hope is that everybody walks away today with at least something that they didn't know, hopefully about surety, going forward. So feel free to interrupt, ask questions. I will leave a little bit of time at the end as well for some questions. I am a third generation surety bonder. My father, his father was in the business. I did a little write-up of the history. If you go to thebonder.com, it'll give you a little bit of history of where the term the bonder came from, as well as my history and my father's and my grandfather's. One more thing before we get started. I did write, I don't know if you can see this. Oh, you can't. A Little Black Bond book. If you go to the littleblackbondbook.com, you can download it today for free if you like. At the end of the presentation, I'll put that address up again, and you can pick up that book for free. All right, so let's start with the simple stuff. What is surety? And sometimes when people ask what something is, it's easier to say what it's not. Surety is not insurance. When I was growing up, I remember my father telling me it's the opposite of insurance. I like to use the word assurance because it's a guarantee, unlike insurance. Insurance is not a guarantee. And I'm going to probably say this a few more times within the presentation, that it is a credit relationship. If you have applied for a surety bond in the past, you know that it feels like you've gone to the bank and you're applying for a loan, because that's very close to the relationship that we have here with surety bonds. It is a credit relationship. And I think it's important to start off with the parties to the bond, so that way when I'm talking through the presentation, you know who's who. So a surety bond is also called a tripartite agreement, which is similar to what it sounds like, right? Tripartite, three parties. So in a surety bond, the minimum amount of parties are three: principal, obligee, and surety. And we're going to go over that in just a minute. So principal, probably you, the contractor, are going to be the principal. I think it's important to understand that you join with the surety, who we haven't talked about just yet, but you're a partner with them. The principal or contractor is the entity that is ultimately responsible for whatever the obligation is that we're bonding. The principal can be a corporation or an individual or a partnership, but that's something important that the surety company is going to want to know. A surety company, again, joins with the principal. So you, if you're the contractor and the principal, you're a partner with the surety company. We only work with corporate sureties, but I think it's important for you to know that there is such thing as an individual surety. And it's because of the history of surety, which we'll go into in a little bit as well. I don't necessarily recommend an individual surety, and most owners are not going to accept an individual surety. So for your own protection, I would recommend a corporate surety and working with a professional surety bond producer. Our last party is the obligee. And I really like the word beneficiary, even though it leans very insurance-y. The obligee is the one that is holding the bond. That's why there's a picture of somebody here holding what kind of looks like a bond. So the obligee is the beneficiary of the obligation. You as a principal, the contractor, are never the beneficiary of the bond. You benefit because you get to enter into a contract or you get a license or a permit, but you are not the beneficiary of this bond. The obligee is the one requiring the bond. So if you're bidding to city, state, county, town, the federal government, those are the obligees. If you're a subcontractor, oftentimes the general contractor will require a bond from you. And in that case, you're the principal, and that general contractor is now the obligee. Any questions so far? I hope I'm not putting you to sleep yet. Surety bonds versus insurance. Since you probably will end up going to an insurance agent for your surety bond, I think it's important to see the difference between the two, because I already said it's the opposite, right? It is not insurance. Surety bonds are typically three parties, sometimes more, which can get a little complicated, and we can go into that if you're interested. Insurance is typically two parties, and I think it's important also to say that nothing is always, right? in life in general, right? It's not always two parties, it's not always three parties, and throughout your life and this presentation, you'll see that nothing is always. Surety bonds protect the obligee. Remember I said that the obligee is the beneficiary, whereas on insurance, insurance protects you, right? When you purchase insurance, you're buying it to protect yourself. When you buy a surety bond, you're buying a surety bond to protect someone else. Usually, surety bonds are project specific, and it's specifically the ones we're going to be talking about today are all project specific. Whereas insurance is term specific. So you get insurance, you know, for a year, and then you renew it. The surety bond claims are made by the obligee, whereas in insurance, you get to make the claim. You cannot make a claim on your own surety bond. Surety bonds, we underwrite to no losses. So when we say we underwrite to no losses, that doesn't mean that we have no losses. It just means that we underwrite. So hopefully there are no losses, because remember I said that the contractor and the surety company are a team. If the surety company loses, the contractor loses. So we don't want to see a loss on a surety bond. In insurance, losses are anticipated, right? They've got actuaries sitting in some room, adding up all these things, really smart people figuring out what losses could happen. So that's the big difference between surety and insurance. And this is my favorite part. I won't read all of this to you. I just think that the history of surety is really interesting. It's been around for a really long time. I do believe it's mentioned in the Bible. 1935 was when it actually became a law for performance of payment bonds here in the United States. The law actually started in 1894 with the Hurd Act. The Hurd Act was to guarantee performance. And what the idea was here, and still is today, the requirement for a bond is to protect us, to protect our tax dollars. So anything that tax dollars, any construction contracts where tax dollars were involved, a performance bond needed to be posted to guarantee that that contractor is going to complete the work. And then in 1935, the Miller Act added on the payment portion of that guarantee. So in 1935 was when we started requiring performance and payment bonds to guarantee that the contractor, the principal, is going to pay their sub-suppliers and material people. And this is going to be a rhetorical question because I have a feeling nobody's going to answer, but in 1935, when the federal government said we need to have this bond, this performance and payment bond for contracts over a certain amount to protect our dollars, our public dollars, our tax dollars, they went to the banks because this is a credit relationship. And I'm sure nobody here was around in 1935, but in 1935, if you remember from history, the banks weren't doing so well in 1935 here in the United States. So the bank said, no, we're not going to provide this guarantee. However, the surety companies or insurance companies, they had money and they were ready to step up and fulfill this obligation. So in the United States, in Canada, and in Mexico, it is insurance companies who are now fulfilling this requirement for you and not banks. Whereas traditionally in the rest of the world, in Europe and in Asia, it's banks that provide this guarantee. So this is why this is not insurance. This really is a credit relationship. There are easily a million different kinds of bonds, and this is not an exaggeration. So if you think about every city, county, town, state requiring a different bond for all different industries, it can add up pretty quick. We've categorized in the surety industry the bonds into two major categories, contract and commercial. We're going to concentrate on contract today, but you should know that there are other kinds of bonds. If you have a contractor's license in the state of Washington, you know that there is a contractor's license bond. So Washington, Oregon, California, and several other states do require license bonds to be a contractor, and that goes under the commercial entity. Some other license bonds for some other industries might be auto dealers. Auto dealers also have to. I'm making an assumption, and you can just correct me if I'm wrong. I'm assuming that the people here are contractors and we don't have a lot of other industries here. If we do, I'm happy to talk about what some of those other industries might need as far as surety bonds. All right, so let's talk about contract bonds. The first bond, hopefully, that you would run into after your contractor's license bond is the bid bond. The bid bond guarantees, it's sort of like a deposit. I like to think of a bid bond sort of like when you go bowling and you give your shoes to the bowling people, and then they give you their shoes, and then when you're all done, you get your shoes back. It's a deposit, right? So that's really what this bid bond is. These are your shoes you're giving to the obligee, right? So who's the obligee? It's either the general contractor or a city or a town or the state. And it's usually a small amount, 10%, 5%, sometimes 20% if it's federal, to say, hey, yes, I am pre-qualified, I have a surety. If I am the low successful bidder, I will enter into a contract and provide the next two bonds, the performance and the payment bond. So it's a small bond. You can sometimes post cash for this bond. Because it's a smaller amount, you may have it. I would suggest not posting the cash, even if you do have it, because if you are the low successful bidder and you can't get a surety company to write your next two bonds, those performance and payment bonds, you will lose that deposit, right? The same way as if you never returned those bowling shoes, you're not going to get your shoes back. So that bid bond is a deposit. So let's assume now you are the low successful bidder. You've entered into a contract. That contract says that you have to provide a performance and a payment bond. That's what those two bonds there are, and very self-explanatory. The performance bond guarantees that you as the principal on that bond are going to perform all of the obligations in the contract that you signed. So that performance and payment bond are attached to the contract. If you read a performance bond, it might be one page, and it basically says who the parties are and that this bond is guaranteeing everything that's in that contract. So it's important for you to read that contract, but the surety company is also going to want to read that contract because they're going to want to know exactly what they're guaranteeing. The payment bond guarantees, this is the Miller Act part of the statute. The payment bond guarantees that you as the principal are going to pay all your suppliers and material people. Part of the reason for this is because you can't lien public works jobs. So this is a guarantee for the subs and suppliers on this. So if you, as a subcontractor or subtrade on a job, and you're working for a general contractor who has posted a bond to the owner, that payment bond that general contractor posted, that is a bond that you as a subcontractor could make a claim on if you are not paid. So again, you're not the one applying for that bond, but that bond is out there to protect you as a contractor. If you know that there's a bond on the job, it wouldn't hurt to get the details of that up front when you sign your contract. So you have that information if at some point you do need to contact the surety company and say you have not been paid. So that's what those are. I'm assuming no questions. I'm not hearing anybody. Everybody's muted. Some other contract bonds that I'd like to at least let you know about are developer bonds and retainage bonds. These are not related at all. These are just other random, oh, yay, somebody raised their hand. Go ahead.
Hi, yes. So let's say it's a $100,000 subcontract that you receive. What is the approximate amount that you'd have to put down? If you're a subcontractor, so you don't have to do the payment bond, but you said about 5% for bid bond.
Yes.
And then how much are you talking for that performance bond?
So when, just to be clear, when I say the 5% for the bid bond is the amount of the bond. It's not the cost for you as a contractor. For performance and payment bonds, those are typically and traditionally 100%. Actually, this is a really good question. I appreciate this.
So
Yes.
what would I be putting out though for those bonds if I'm a subcontractor? How much would I pay if I'm a fairly new, don't have a lot of experience, $100,000 subcontract? How much am I putting out?
You're probably looking at 3% of the contract price.
And how much of an advantage does someone that has a long history have over me as relative to what I'm having to pay compared to what they would pay?
This is an awesome question. I do have a slide on it, so I'm going to reiterate everything I'm saying now because I think it's important. Starting out, again, let's think about this as like you're going to the bank and borrowing money, right? If you don't have a lot of history with the bank, if the bank is, your rate is going to be based on probably your credit and the information that you've given to the bank. And that is similar to surety bonds. There are a lot of things associated with how rates are developed, but there are some traditional rates, and 3% is of the contract price. I think that's really important to note. Because you asked earlier, the performance and payment bond are 100% of the contract. So when we write the bond, it's going to be for 100% of the contract price. If for some reason they only want a 50% bond, the surety company is still going to charge based on the contract price. So if you have a
so if it's $1 million
Yes.
contract, I have to pay 3% of $1 million.
Well, hopefully by the time you get to $1 million bond, we've done some work behind the scenes to get your rate down.
So, but what if I'm talking about, I am the subcontractor, the total contract is $1 million, my portion is 100,000.
Yep. Oh, your contract, because the performance bond is attached to your contract.
Okay.
It would be the amount of so it's based on your contract.
Got it. Okay, thank you.
These are awesome questions. Thank you for that. Did I fully answer that? I can keep talking about that.
And so the 3% was the cost of bid bond plus the performance bond for me.
The bid
as a
bonds
subcontractor.
the bid bonds are free, typically. So every once in a while, the surety company will maybe charge a $100, $50 fee, but traditionally bid bonds are free. The performance and payment bond, however, that's where the surety company charges. When you do your bid, though, and this is really important, make a note of this. If there isn't a line item, if a performance and payment bond are required, and there is no line item for the cost of that, the cost of those performance and payment bonds should not come out of your pocket as a principal. These bonds are protecting the obligee, and they should be paying in the same way that they pay for insurance. They should be paying for this performance and payment bond. It should not come out of your profit and overhead. So if there isn't a line item, you need to get that cost in there somehow. Oftentimes there is a line item for that.
Okay. Huh, interesting. Okay, thank you.
Absolutely. I have two more raised.
The line item would be in the contract from the obligee or from the contractor to the subcontractor?
It could be in both. Wherever there's a bond required,
okay,
there should be, and it won't be necessarily in the contract. It'll probably be in the bid specs. So all bid specs look different, and sometimes there are different line items for different items that you're bidding. And the bond, if there is a bond requirement, there should be a line item for that.
okay.
Is that clearer?
Yes, thank you.
Yeah. You have your hand up, Andrew. I can hear you.
I just raised my hand to point out that Geezer is over here raising his hand on the screen as though he would like to speak. So
go ahead.
direct your attention to him, please.
Thank you. Good morning.
Morning.
I have engaged in many contracts that involved bonds, and I appreciate everything you've said, but there's a little bit of ambiguity that I'm hearing. So you said 3% of the overall contract, and I totally understand that. However, The bid bond is quite something different because you don't know what your contract is going to be. You're giving a bid. So can you kind of delve into that a little bit better so we understand
Sure.
what the percentage of the bid bond will be? I know
So
that a lot of times in government contracts, they have a value assigned to subcontract work, and there's a sort of a guidance, but
Yeah.
that doesn't necessarily mean that's where that bid is going to end. So can you give us some
Right.
enlightenment on that, please?
Absolutely. So I'm assuming when you say that there's some guidance that sometimes there is what we might call an engineer's estimate. Whether it comes from an engineer or not, I'm not sure, but they give you as the bidder some idea, an estimate of what they think is the contract's going to cost.
Right.
So depending on whether there's a line item or not, somehow you have to get the premium for that in your bid when you're still bidding the job.
I understand.
You may not know exactly what the price is going to be, but you also have estimates for everything else that you're bidding. So my suggestion would be similar to the way that you bid some of the other items on your bid. You might want to round up the cost of the performance and payment bond. So what happens here, and I think there's a term for this, but let's say when you're bidding the job, you come up with the $100,000. Okay, so your bid's $100,000. Now, you haven't added in the cost of the performance and payment bond, so you need to add that in there somehow. So now your contract price has increased, right? A little bit.
Sure.
And now your contract, the 3% is now going to be based on that little bit of larger amount, and it becomes circular. And so really just rounding up and estimating a little bit high. And I realize that you're trying to compete, so you want the lowest, but at the same time, there's no need for the cost of the performance and payment bond to come out of your profit and overhead.
I understand, and I totally get that. But what I'm driving at is, what is the percentage of the bid bond? What's the cost of the?
Oh, there's no
bid
cost for
bond?
the bid bond. The bid bond is free.
There you go.
That's
So
it.
it was, like I said, it was a little ambiguous because it sounded like there was some cost associated with that bid bond. It doesn't become a cost unless you're the successful bidder.
Correct.
Okay.
And performance and payment bonds are provided.
That's
Yes.
the point I was trying to get to everybody.
Got it.
In addition to that, it's in my experience, sometimes when you're doing government work, the entity or the obligee, the government, has a line item, and they tell all bidders that they will be paying for the bond, whatever that cost is. They get it a hell of a lot cheaper than we do, because obviously they're not going to default. They have much better credit, et cetera.
Sure.
So you can find that in the bid documents most of the time.
Right.
Cool.
Thank you. I appreciate that. You probably look at a lot more bid documents than I do. All of you probably do. So and they're all a little different, right?
Indeed. Thank you.
But I just want to make sure that if there isn't a line item for it, that somehow you put that into your bid so that like I said, it's not coming out of your profit and overhead. Bid bonds are free. The performance and payment bond are charged for this class of bond is charged once. In other words, if a performance bond is required and a payment bond is required, you're not paying twice. In the surety's eyes, it is one guarantee. Sometimes it's two pieces of paper, sometimes it's one, and you really just have to read the bond form to know if it's going to be a performance and payment guarantee, but the cost is the same, whether it's one performance bond, one payment bond, or one of each. Does that help answer most of your questions? I appreciate you guys interrupting. Thank you. All right, we're going to go on to a couple of other bonds. Developer bonds and retainage bonds. And the reason that I picked these is because developer bonds sound, when you look at the actual bond form, it looks really similar to your contract bond, but the guarantee is very different. If you're a developer, you have to have the money to develop the property. As a traditional contractor, you're being paid by somebody to do the work. And that's really the biggest difference. So being a developer, much riskier, being a contractor, a little less riskier. So the underwriting is very different for it. And if anybody is doing developer stuff, I'm happy to talk about that as well later on if you like.
Sarah? Or Kara, what did I say it wrong? Sorry, it's Kara.
That's okay.
Kara, did you see there's a question in the chat?
Oh, no, I can't. I didn't see that.
It says, how are change orders handled
Oh.
regarding performance and payment bond?
This is such an awesome question. That's a great question. And when we send an approval with the cover letter and our invoice, we spell this out because it's actually super important. Every time you do a change order, especially if it's increasing the contract price, you are going to have to put in a little extra premium. Here's why. Early on, I said that the contract and the bond become one document. Basically, the bond is made part of the contract. So anything that happens in that contract also happens on that bond. So if the contract increases or changes in any way, the guarantee also changes. And we, as a surety company, don't have a lot of say in that, right? Hopefully you have some say in the changes that happen, and hopefully they're to your benefit. And when they are, and there is an increase in that contract price, add in the premium for that increase. Because at the end of the job, the surety company is going to contact that owner, that obligee, find out what the contract price, the final contract price is, and they will charge you for that difference if the contract price has gone up. If the contract price has gone down, there is a chance that there will be return premium as well to you. Is that helpful? That was a really good question. Thank you. Anything else? All right, let's talk really quick about retainage bonds. Most contracts do have a retainage or a holdback. Some obligees will allow you to provide a release of retainage bond, is what it is technically called. These can get a little bit complicated, and I'm going to try and simplify it as best I can here. Let's say that you have a contract with a 10% retainage. That means that there's a holdback. Every draw that you take, there's a holdback of that 10% from the owner, the obligee. At the end of the job, you get your retainage, hopefully, as long as all the punch list items are done and so forth, you get your retainage back, your holdback, you get it back. For very large, very long-term contracts, these are bonds that we do for well-established contractors who we have a relationship with. And if for some reason they want that retainage either early or throughout the contract, we can post a retainage bond, a release of retainage bond, so that that contractor, instead of getting 10% less on every draw, is going to get 100% of every draw. The retainage bonds can be posted either in the beginning or, which happens often, if for some reason the contractor is like, it's been a year, I still don't have my retainage, which I'm sure will hopefully never happen to you guys. We can post a bond then. The contractor can get their retainage back, and that bond is a placeholder for that. Again, it can get a little complicated, and usually these are done for large, long-term contracts for well-established accounts. So it might not be something, if you're relatively new, it might not be something that you can obtain right away, but you may see this in specs, you may hear other people talk about it, and I feel like it's something you should at least know about and something to shoot for eventually as you grow. Yeah. There we go. All right, so we're mostly done talking about kinds of bonds and what bonds are, and I'm going to go into a little bit of underwriting, and I'm going to try to make this as interesting as I can, because we're going to start going into financial statements, and I don't want to scare everybody away. But I think it's important for you to know what to look for, and that these are all standard operating procedure for surety companies. All surety companies want to see this. If you are looking for something relatively small, and the definition of small would be somewhere probably under $500,000 or so. If you're looking for something relatively small, you have great credit, you've been in business at least a few years, you may not need all of this information. We may be able to get a surety bond based on credit or based on the application and just a little bit of financial information without this full underwriting package. As soon as you start getting creeping up to about $1 million, that's when we're going to need this full kit. So it makes sense to start working on this kit right away, so that way you're ready if you do want to grow into a million single or more. We need a questionnaire application. This just gives us an idea of your background, your largest jobs, and that kind of thing. 3 years financial statements. So what the surety company is looking for there are 3 year-end financial statements plus a current interim. We're going to go into financial statements a little bit, and I promise I'll try not to bore you with that. We need a bond request. It doesn't hurt to get pre-qualified, which means you don't have a bond request, and we just pre-qualify you. It does help speed things along if you do have a bond request, though. Think of this, like I said earlier, like you're going to the bank, right? And you're, let's say you're going to buy a house. You haven't picked out the house yet, so you want to get pre-qualified. That's basically what we would be doing here. If you don't have a bond request, we would just pre-qualify you. But we do underwriting on you, the principal, the contractor, and the individuals. And then we do separate underwriting on the actual bond request. So not every single bond request necessarily will get approved if you are pre-qualified. Probably the same as if you want to buy a house. If there's problems with the house, the bank might not honor yet that pre-qualification. The agent write-up is something that we do. And I put it on here because I wanted you to know the work that we do behind the scenes. And the best way for us to get a really good, what we call a write-up or a presentation, is to get to know you, the contractor. This business, any business, I should say, is about relationship. You know this when you're out there working with your subcontractors, your laborers, your employees, your owners. It is all about relationship. And I know this is not specific to surety. This is really just business advice. And you may have already learned this, but relationships are paramount, really important. So developing a relationship with all the people, all the entities that you already are, as well as your insurance agent, your surety bond producer, your banker, your attorney, your CPA. Those relationships are really, really important and are going to help you succeed. Resumes, references, business plan. These are actually not always required depending on how long you've been in business, but it's always nice to have to potentially help increase your bonding. A bank line and bank statements. And I touched just a little bit ago about having a relationship with a banker. And I want to go into that just a little bit more because this is a really important relationship for you as a contractor. Developing a relationship, and then hopefully, if you don't already have it, a working capital bank line. So what this is it's going to feel actually really similar to what we're doing here, right? Financial statements and that kind of thing. So if you're going to apply for either a bank line or surety credit, it might make sense to do it at the same time, because a lot of the information that the bank needs for a bank line, as well as the surety company, are going to be really similar. So it might be worth doing both if you don't already have a bank line or surety credit. Something too about banks, not all banks understand your business. Not all banks understand construction. And not all banks are meant for corporations and companies and businesses. A lot of banks like personal accounts. So you need to find a bank, and specifically a banker, that understands your business, that understands construction, and maybe even your type of construction. The bank line is going to be really important to you as you grow. So having that relationship is going to be paramount. All right, this is going to help explain some of why we ask for what we ask for. And I think you guys, everybody should know the 3 C's of surety: character, capacity, and capital. And I put character first on purpose. Character, how do we underwrite character? We basically underwrite character with the other two columns, capacity and capital, but it's honesty and openness. It's how you do a job and how you leave a job, that kind of thing. I like to develop, again, a relationship. It's the only way I know how to underwrite character, is to have a relationship. And it doesn't have to be anything fancy, a couple of phone calls or a meeting, a Zoom meeting like this, or a meeting in person. Eventually, hopefully we get to see a job site and get to see how you run a job site, that kind of thing. So that's character. Capacity is the ability. Are you able to do the job? Have you ever done a job like this before? So in this category, we're going to be looking at your experience. What have you done in the past? Is it similar to what you're looking to bond in the future? We're looking at the size of jobs. If your largest completed job is $10,000 and now you want 10 million, probably isn't going to happen. We need to do some stair stepping there. So again, capacity is about experience. And actually, I should note, this experience, one, does not have to be bonded for you to have experience, right? So we're going to look at experience that may not have been bonded, which is totally fine. It's still experience. But if you're relatively new in business as well, and maybe your company doesn't have the experience, but maybe you as an owner, you have experience with prior companies, that's where that earlier I mentioned resumes and business plan. That's where that kind of information can be really, really important. So if you're relatively new in business and you want to start doing bigger jobs, you have the experience, we need to show the surety company that you have that experience. So we may end up calling, with your permission, of course, prior jobs to see how you did and what the actual contract price was and so forth. And that's where capacity comes in. And the reason I put character and capacity first, because these are things that I think can happen more quickly. These are things that you can work on right away, whereas capital takes a little bit longer. We're looking at financial statements and we're going to be looking at historical stuff. So you can't really do anything about what's already happened. You can only do things going forward. What does your credit look like? And we'll go into credit in just a little bit. But again, that's not going to change. If it's not great, it's not going to change quickly. Credit reports. The first thing the surety company does when they get a submission is probably run your credit. You as the owner of the company. There is business credit too, but if you're relatively new in business, there may not be anything there. There are 3 credit reporting agencies, and if you come to somebody and you say, I have a 750 score, when the surety company runs credit, it may not show that because each credit reporting agency handles things differently. They all have different numbers and they all have different algorithms to come up with those numbers. I did learn something a while ago and want to pass this on to you guys too about credit reports. A lot of times people think if you pay off all your bills and close your accounts, it will help your credit. And it sounds like a good idea, but please do not close accounts, credit accounts, unless you really have to. If it's costing you money, of course, that's your decision, your business decision, you need to make that. But part of the algorithm that the credit reporting agencies use is how much available credit you have. So if you have credit cards or you have other credit out there and you have an available balance on it, that is going to help your credit score. If you close that account, now the algorithm, it looks like you don't have as much available credit because you've closed that account. I hope that doesn't, I think that's pretty clear. But if you don't have to close accounts, don't close accounts. It will help your credit score. The Fair Credit Reporting Act basically just says that we all have to be fair, of course, fair, and that it's all private. So when the surety company runs your credit, we're not allowed to tell you what's on it. We're not allowed to share the report with you. You have to get that on your own. Is there something in the chat? Or maybe I just, maybe it's old.
No, I was just confirming because I have a background in the financial industry for over 25 years and working with credit with
Yeah.
borrowers. You are very correct when you go to close a credit report and what that effect has on your credit score.
Right. And it seems innocuous, like it wouldn't do anything, but it really does. Do you know, are there other things that that you know from your experience about credit reports that would help?
So what I have found and is very interesting there, when you look at your credit score, they're very helpful in providing clarification on how you are rated. And so I think a really big piece of that is the amount of credit that is available. There are certain percentages on that available credit balance that really affect your credit score. So if you're pushing the maximum limit of what you have available, your credit score could be down 30 points, which would be a very large consideration for someone that is looking to lend to you. So you really want to make sure that you're within those percentage qualifications to make sure that your credit score stays well above. Well, what we really look at when we're looking at personal lines, or if you're looking at business lines, we're looking at 660 or 680 and above, but you really want to be up in the 700, 750 or above.
Yes. Thank you. I appreciate that. Yes. And that's really what the surety companies are looking for too. And this is why this is the first thing we do is we run credit. We try really hard not to put you as a contractor, the principal, into a little square. And if you get like let's say you're a 600 or a 650 or 649, let's say you're a 649 and the cutoff was 650. We're going to, as a surety company, as the surety bond producers as well, we're going to take a closer look at that credit report, because sometimes those numbers, because there's some weird algorithm, sometimes a 650 or 649 for one person, well, actually, there's nothing really negative on the report. Whereas another person, 649 could mean a bankruptcy. So it's, we really do need to, I think it's important to take a quick look at the actual report and not just look at that number. And I think you too, if you get a chance, and you can do this, I believe, once a year for free, contact the credit reporting agencies, get a copy of your credit report, and take a look at it. Like really take a look at it. I think that's not a bad idea for really not just contractors, but for everybody to be taking a look at their credit report, making sure that it's accurate. If you are declined for credit, I believe the Fair Credit Reporting Act allows you to go to that agency and get a copy, a free copy of your credit report, so that you could get it. If for some reason you were declined, you could get that credit report more than once.
So Kara, also to be included in that would be, I will put a link in the chat for one of the best links for checking all 3 credit bureaus for free every year that I personally use and have referred to my clients in the past. Awesome. I do have a question. When you mentioned bankruptcy, what is the threshold of years that you look to when you're able to work with somebody on the surety bond? Like when you're doing lending, they look past a 4-year mark, depending on what type of loan it is.
Right. And that it's going to be similar to, it's a little bit case by case. If you're in the middle of a bankruptcy, we can't help if the bankruptcy is still open. 3 to 5 years, depending on the surety company. So we represent the top 50 surety companies in the United States. There are a handful of surety companies, if you have ever filed bankruptcy, they won't write a bond. And that's just a small handful. The rest of them, they're going to want an explanation, no matter how old the bankruptcy was. They're going to want an explanation. Included in that explanation are steps you're taking to make sure that you don't file bankruptcy again. But we're probably close to what you just said. Probably 4 or 5 years is where we're going to want to see that bankruptcy. But I don't want to discourage anybody if your bankruptcy's at the 3-year mark. don't hesitate to reach out, and it's not going to hurt to go through a little bit of this and kind of get your file rolling so that maybe we can get something small for you. I don't want to discourage anybody. If you're in the middle of it, we can start something. I'm not going to be able to get surety credit for you, but if the bankruptcy is closed, we have a nice written explanation or typed explanation for it that makes sense and that you're taking steps to improve. I don't want to discourage anybody from applying for credit. All right, any other questions on credit reports? Oh, for crying out loud. There we go. All right, I promised that I wasn't going to be too boring on the financial statement side, but if you are a business owner, whether you're a contractor or any other business owner, you do need to know some basic financial statement information. You do not need to be a CPA, but you do need to know the basics.
Tara, excuse me, just a moment.
Sure.
I just raised my hand. I don't know if you could see me, but
I can't
that's
see you.
okay.
Go ahead.
Backing up with regard to credit.
Yeah.
You had credit reporting agencies, business and personal, et cetera. You didn't mention anything about Dun & Bradstreet. Do you access that?
There are some surety companies that do access that. I always take everything from not just D&B, Dun & Bradstreet, but from the credit reporting agency as well with a grain of salt. The way that I understand how Dun & Bradstreet works is you as the client need to pay Dun & Bradstreet to make sure that your business, your D&B credit report looks good. And the idea that you need to pay somebody for that does not seem ethical to me.
I understand, and I totally agree. Yeah, I understand exactly how that works. It's kind of like the Better Business Bureau.
Right. Yes.
Yeah.
Yes.
They like to promote themselves quite well. And even some contracts require you have a DMB number.
Well, and getting I think it's called a DUNS number is different, I think, than the actual report.
Right.
And I think, Leslie, do you want to pipe in here and help us?
Yes, I do. In regards to federal contracts, and historically, Dun & Bradstreet provided the digital unifying number, which is the DUNS number. And over the years, particularly in the last few years, the federal government has become not real happy with Dun & Bradstreet because of their marketing techniques and the billings that they are doing to anybody that wanted a federal contract. So the federal government is now moving away from DUNS numbers. If you have one already, you can keep it. But moving forward, they have a Unified Identification Enterprise. It's a UIE number. And so in the future, new companies will register with the federal government without a DUNS number. And the reality is, let me give you just a real quick backstory on the DUNS numbers. So, back in the 60s or 70s, the federal government wanted to create this database of small businesses, and they wanted to be able to keep track of them numerically. And so they listed an opportunity for somebody to come up with a digital unifying numbering system. And I can only imagine the guy sitting at Dun & Bradstreet looking at that and jumping at the chance. And so they basically had a renewed contract every year until about 3 or 4 years ago when the federal government had had enough. So everything that you do in regards to the federal government should not cost you for registration or anything else. And if Dun & Bradstreet is calling you, reminding you, as P-Tax, we recommend that unless you have a personal interest in staying with them, the federal government does not require you to do that. So moving forward, we'll have broken away from Dun & Bradstreet. And, I counsel all of my clients to, it's buyer beware, on getting scammed on, the cost for registrations, in order to stay with Dun & Bradstreet, whatever it is. So if you have any questions at all, be sure to connect with your local PTAC or me. I'll have my information in the chat. But yeah, the Dun & Bradstreet, that's kind of like a red herring.
I really appreciate that. I was trying to be PC there, but I appreciate the history, and I knew about the DUNS number, and that you can get the DUNS number for free, I believe. But then Dun & Bradstreet now has you. They know who you are, and they're going to continue to market to you. I'll just say market to you.
Yeah. So thanks.
I appreciate that. Thank you. Anything else on EMB or credit reports? And keep interrupting. This makes it really fun for me. So I really appreciate this. I can't always see your hand raised. I think there are a small enough group that we can just interrupt each other. So feel free to do that. Again, back to financial statements. I know that you are trying to get away from this, but I'm not going to let you. Everybody needs to understand just a little bit about financial statements. The two reports that are going to be the most important for you, as well as a surety company, remember you're a team, is the balance sheet and the income statement. The balance sheet is a snapshot in time and says this is what the company looks like for this one moment. So we've got assets and liabilities and net worth. On the income statement is over a period of time. So a lot of times people will call this income statement a P&L, profit and loss. So what this does is it lists all the revenue, all your expenses, and what the outcome is over a period of time. Surety company likes to see a year end. They like to see it 3 year ends, meaning that if your year end is 12/31, we would get a balance sheet as at 12/31. We would get an income statement that includes the whole year at 12/31. If we're in the middle of the year, let's say we're in June or July, that year-end financial statement is important, but the surety company will also want to see something a little more current. So we'll want to get maybe a June 30 balance sheet and income statement as at the same date. The three things below the opinion page, schedules and work in progress, are important, but not the most important. The opinion page is only going to come from a CPA if you have a CPA prepare your financial statement. The accounts receivable and accounts payable, that's where schedules AR and AP. Those, if you're using software like QuickBooks, you should be hopefully putting this information into QuickBooks, all your accounts receivable, all your accounts payable, and you should be able to print those schedules also from your QuickBooks or whatever you happen to be using, and keeping track of the money coming in and the money going out. The work in progress report is, I just don't want to say how important it really is because it is so important. This is something that if you're doing a lot of really small contracts, it might not make a lot of sense. If you are planning to grow, learning how to use a work in progress report for larger long-term projects are going to be so valuable to you as a contractor, as well as to your surety company. Again, we're a team. And all of these, the balance sheet, income statement, ARs, APs, and work in progress should be a tool for you as a business owner. It's really easy as a contractor to print all these things out and throw them to your banker or your surety bond producer. and not look at them and not use them as a tool. These are your tools to see where you're at, where you've been, where you're going, and help you make decisions moving forward. All right, again, I'm only going to do 2 more slides on financial statements. I promise not to bore you too much with this, but this is important. Financial statement quality. So you've probably heard people talk about CPA audits, or hopefully you have. The lowest financial statement quality, and this doesn't mean that it's bad, is internal or in-house. And what an internal in-house financial statement looks like is you print it from QuickBooks or whatever software you happen to be using. And you can print that balance sheet and that income statement from there, as well as your ARs and APs. A CPA compilation is basically what it says. The CPA takes those internal reports and they put it in a fancy little binder thingy, and then charge you some money for it. They basically, all they're doing is compiling the information, making sure that it adds up properly. They're not really checking a whole lot when they do that CPA compilation. The CPA review means that the CPA has actually reviewed the numbers and they've gone into some more detail while they're doing putting all your financial statements together. And this will usually, they'll take a much closer look at your WIP report, your work in progress report, as well as verify a lot of the other information on there. When you're starting out, getting a CPA review or a compilation might not make sense right away. It's expensive. However, getting a relationship with a CPA and at least having them help you set up your internal books will be invaluable if you are, especially if you are planning to grow. At some point while you're growing, when you want to get up to the $1 million, $2 million range single, the surety company and possibly your bank, if you have a bank line, they're going to want to see a CPA reviewed financial statement. A bunch of slides back, we were talking about rates, and I was saying that 3% is kind of the coming into surety rate. Once you've been in business for a few years, if you can provide a CPA reviewed financial statement, that rate will, as long as the numbers qualify, that rate could come down. So this is one of the ways to get your rate down. And while you, the principal, the contractor, aren't necessarily paying it, it's not coming from your profit and overhead, hopefully, you still are competing. And especially if you're competing on larger jobs, that premium could be the difference between getting a job or not getting a job. So paying for a reviewed financial statement could come in handy. And when you get to that point, I'm happy to talk to you a little bit more about it. Usually what I'll do is we take a look at the in-house financial statement and see what those numbers look like, assuming we're all assuming that they're pretty accurate. Then we would say, yes, let's get a CPA reviewed. It's a tool for you as a contractor. It will also hopefully help reduce your rate and maybe even increase or get a better rate at the bank as well. I don't expect that you will probably ever, or at least it'll be a long time before you need an audit. A CPA audit is very expensive, and we're looking at, I think if you were doing maybe like 40, 50 million in revenue a year, that's about the time we might start talking about an audit. But this is something you would talk to your bank, your CPA, and your surety bond producer about before you run out and get these things. Okay, one more sheet on financial statements, I promise. Okay, this is the method of accounting. And this is important because when you're putting information into your system and you're accounting for your business, you want to make it so that it's useful for you as well as useful for the other people looking at it, like your banker and your surety bond producer. Okay, in construction, there are 4 different ways to count your money. And this partially is why it's so complicated and so important for you to get a CPA that understands your business, as well as getting a banker that understands your business. You do want a CPA that understands your business. The only industry that has 4 is construction. How most contractors come into construction, they're using cash basis of accounting. And the reason for this is because it's going to show probably less income, and you will probably pay less in taxes that particular year. So how cash basis of accounting works is you only count the dollars you've actually received, and you only count the expenses that you've actually spent dollars on. So we're missing in the cash basis of accounting, we're missing all those accounts receivable and accounts payable. And in construction, there could be a lot of accounts receivable and a lot of accounts payable that we're missing. And it's not an accurate picture if you're looking at your cash basis of accounting. So you can report your taxes on a cash basis of accounting, and your internal reporting as a tool for you, your surety, and your banker move to accrual basis of accounting because it's going to be a more accurate picture of your business. And again, I want this to be, these financial statements to be tools for you as a business owner to make informed business decisions going forward. And having an accurate financial statement is going to help you do that. And your surety bond producer and or banker can help you take a look at it and read these financial statements if you're not sure what anything means on them. We're happy to do that for you. The other method of accounting is the percentage of completion. This gets a little complicated and takes into account that work in progress report that I talked about earlier. It's something that the surety company, if we can get an accrual basis of accounting financial statement, if we have a work in progress report, we can add in that information because most software doesn't incorporate that easily. The last method of financial statement accounting is completed contract. This you will probably not do for anything other than possibly taxes. And what this does is you only count the dollars of the contracts you have completed. So while this works for taxes, this is not going to be a good tool for you as a business owner, but doesn't mean that you can't do that. And this is something you would talk to your CPA about. Okay, I'm done talking about financial statements. Are we all still awake? I hope. Any questions on financial statements? Okay. A presentation to a surety. A complete submission, and your surety bond producer should be able to help you with that. Allow time. Coming to the surety company for the first time when you have a bid that's today at 2 o'clock, we're going to have a problem. So as soon as you think you may need bonding, come to your surety bond producer and tell them what you think you're going to need, the approximate contract price, and so forth, and let us help you as early as possible. If you do come to us late, we're not going to turn you away. Our office won't. We'll do everything we can for you, but allowing time is going to be really helpful. Communicate, and I really feel like communication kind of goes hand in hand with what I was talking about earlier about relationships. Communication is what is going to build those relationships, and I put communicate here as your presentation to the surety, but again, this is really life advice. Developing relationships, learning how to communicate effectively is going to help you in every area of your life. So why get a bond? Why set this up? Number one, I think, is competition. I've talked a whole lot already about all these things these hoops you have to jump through, and a lot of contractors aren't going to do it. So if you have the gumption, the grit to do this, and we promise not to make it too painful, you're going to have a little less competition because not everybody can qualify for a surety bond. You also have the partnership with your surety bond producer and your surety company. We work with a lot of contractors. The surety company works with a lot of contractors. We have some resources. We have some experience. We're going to take a look at those contracts. We're going to point things out to you that you may not have looked at before. We're going to give you advice on how to grow and the best way to grow. We might have resources on CPAs, attorneys. A lot of surety companies have those resources on staff. They all have attorneys on staff. A lot of them have engineers on staff, so that if things start going wonky with your job, you have a partner, you have a resource. And all the resources here, SBTRC, PTAC, all the alphabet soup people we have here. they're all a resource for you as well. We did kind of go, well, no, we didn't kind of, we went over, I think, the costs and premium, but to just reiterate, because I think this is important, bid bonds traditionally are free. So everything from our office is free. Every once in a while, I think there are some small fees for bid bonds, but bid bonds are free. Performance and payment bonds, the average rate for coming in is about 3%, but it should go down as we start developing the program. You start developing a relationship with the surety company, and we can get financial statements prepared by a CPA. That's going to be a big move to the rate, and could bring it down. After that 3% rate, we might be looking at a 2.5% rate. Then we start looking at rates that are tiered. So smaller contracts might cost a little bit more than larger contracts. Like a $10 million contract might work out to something less than 1%, to give you an idea of how those tiers work. If you need other bonds, those may not be the same rate as your performance and payment bonds. So depending on the kinds of bonds you're looking at, remember we touched on retainage bonds. Retainage bonds, if there's a performance and payment bond, are traditionally, and again, every surety company is a little different, but traditionally around 1%, sometimes 2% if there was no performance and payment bond. So there are some other rates out there for the different kinds of bonds. And I know we did talk a lot about cost and premium, but are there any other questions on that? Okay. Surety red flags. When it's a surety red flag, it's also a red flag to you, because again, I'm going to keep saying this, you are a partner with the surety company. Anytime you're looking at a job that's larger than anything you've ever done before is a red flag. Anytime you are going to a new territory, let's say you're in Washington, you're like, ooh, Alaska looks cool, and you want to go to Alaska, very different territory, a little red flag. And a new scope of work. Let's say you're a drywaller and now you want to do plumbing. Red flag. So a red flag doesn't mean a declination. It doesn't mean that you're not approved. It just means that we're probably going to have a lot more questions, depending on how big the increase in job size is. If you're looking at all three of these things, in other words, if you're looking at the largest job you've ever done in a territory you've never worked in and a scope of work you've never done, that probably will be a declination. And again, the surety company wants to see you succeed. We're partners. When you succeed as a contractor, the principal, the surety does. So the more successful you are, the more successful the surety company will be. They want to write more bonds. I never, ever want to write that bond that puts you out of business. So we're going to give you the advice and help you through this as best we can. Preparing for a hard market. So maybe I should define what that means first. In insurance and surety, we talk about hard markets and soft markets. A hard market is where getting a surety bond might be a little more difficult. A soft market would mean that it's a little easier to get that surety bond. The surety industry is a little bit behind all the other industries. So we're still sort of in a soft market, but it is starting to harden up a little bit. So some of the things that you should prepare for, and actually maybe I should just say you should be prepared for anything, because we never know what could happen, like a global pandemic. Have a plan, which of course we could never have had a plan for this, but having a plan and some emergency plan will help you. And our office did. We had an emergency plan, so when all this happened, we were really prepared to just go home. And well, it hasn't been fun. We're all doing it, and it worked out well. Build cash reserves. Easier said than done, but something to think about when you're planning and preparing for your business. Controlling overhead will help with that. So just reviewing those financial statements. Remember I said those are a tool for you. Reviewing those financial statements and helping to control, oh, how come we spent this much more this month than we did last month? That kind of thing. Solidifying that bank relationship. And I know I've been harping again on the relationship piece here, but having your bank behind you before you need their help is going to be a huge, huge benefit to you as a business owner. Develop that bank relationship, get that bank line of credit before you need it. Because once you need it, you may not qualify for it. So get that bank line as soon as you can qualify for it, and keep a solid banking relationship. Some of the things to increase bonding, as well as reducing premium, we talked a little bit about already. Finding a construction CPA and developing that relationship. Your accounting method. Remember, we talked about cash and accrual. If you're on cash, it's going to be a little bit harder to get surety credit for you. If you move to accrual, it's going to make it a little bit easier. Percentage of completion is exactly what the surety company wants to see. So those will all help increase your bonding. And also working with a surety bond professional. Your insurance agent can work with someone like our office so that they have a surety bond professional. We have those relationships with the surety companies. Part of my job is just that, developing those relationships with the surety companies so that when we need something, we have a relationship with somebody that can help us out. Not unlike you as a contractor and your relationships with your subcontractors. You know that the stronger those relationships, the better the business is going to go, and that contract is going to go if you have a relationship with your subcontractors.
Kara, can you see me?
That
Can you see me?
I can't see you.
You can't? I'm sorry.
No, that's okay. It's because I'm looking at my screen.
I see. Okay, well, this is Geezer. To
Geezer.
just expand on one of the things that you just delved into, and you hit on it earlier as well, the work in progress.
Yes.
In a lot of contracts, that's required information that you have to submit in order to get paid. Basically, like submitting a payment request. They want to know some work in progress information.
Yep.
And it also allows the surety company, you, to understand the wherewithal of the contractor. So
Yes.
the largest job that's been performed, yes, that's very useful information. However, if you've got 5 or 8 jobs going,
Yes.
that all adds up and may far surpass your largest single job. And
Yes.
that's really useful information. It's essentially like another way to build credit.
Yes.
So if you've got those 8 jobs, you're performing well on every one of those jobs, and you're doing an accrual method of accounting,
Yes.
you have a much better snapshot of the creditworthiness and financial wherewithal of those individual contractors.
Yes.
So that's really, really important to understand. And it's not that hard to understand. It may be new to some people,
Right.
but essentially it's just a snapshot of how much work you have, how much has been performed, how much is still outstanding. Again, it kind of ties into the accrual method of accounting, how much money you're going to get out of those jobs when you finish performing those.
Yes. No,
So-
that's great. Are you a surety bonder? Do you want a
No,
job?
I've been a contractor for nearly 40 years, and I
Okay.
do have an accounting degree.
Got
So
it. Okay. That work in progress report, I think I could probably do a 3-hour class just on that report and how important it is. I do have, and I'm happy to share it with you. I have an Excel spreadsheet where you need to fill in 4 columns. So those 4 columns do need to be correct, and it will calculate overbillings and underbillings and cost to complete and all of that. And I'm happy to go over that with anybody who's interested. Sometimes it feels like a lot of work when you're working with really small short-term contracts, but I think that's the time to start practicing. Start practicing using the work in progress, because this really, really can be a tool for you. If you keep up on this, you will know how you're doing on a contract early on, and
Yep.
not wait till the end of the contract to find out that you just lost a bunch of money.
Yep.
Right?
Thank you for that.
Yeah, thank you. All right. And I can't have a presentation without talking about the indemnity agreement. We all know, well, maybe, what the word indemnity means. It basically is to make whole. And if you have an insurance policy, you know how indemnity works on the insurance side. And for surety, it is again the opposite. So the indemnity on your insurance policy, if you're in a car accident, the insurance company will indemnify you, right? So you are made whole, no more, no less. Hopefully they replace your car, something like that. And I'm not an insurance person, so this is just an analogy. For surety, it is the opposite. The surety company is essentially setting aside this. So let's go back to our $100,000 bond contract. The surety company is figuratively setting aside that $100,000 on your behalf. And if you successfully complete the job, then they can put that money back and the bond is done and void. If the surety company has to step in, if for some reason you default on the contract, if the surety has to step in and help, and they will, they're your partner. At the end of that, whatever expenses they incurred, the surety company will come back to you, the principal, to be made whole. So this is the opposite, right? Instead of you, the principal, being made whole, the surety company is made whole. And that's what indemnity means here. It's actually, because surety has been around for so long, there are a lot of common laws. So even if you didn't actually sign an indemnity agreement, there are common laws saying that you would indemnify the surety company. So it's informing you of those. It says that you, the principal, will reimburse the surety for expenses, but it also allows the surety company to negotiate on your behalf if there are claims. And you do want your partner with you. You want your partner, your surety company, to help you when you're having trouble. And please do not, if there's a problem on a job, and I can guarantee you, you guys can probably tell me, every job has a problem, right? But if it starts looking really scary, come to your surety bond producer, come to your surety company. We are your resource and we want to make sure that you succeed. We really do. IntegritySurety.com will have some information. I mentioned earlier the littleblackbondbook.com. You can download that book for free. If you want an actual copy like this, you can also get a copy of that on Amazon. And when you go to littleblackbondbook.com, you can get a copy of that. And then a little bit about me and my history. If you go to thebonder.com, you'll see that there. I might leave that up in case you guys want that information. And I saved a few minutes. If you have any other questions, or I can just keep talking. Go ahead.
I do have another question. This is Geezer.
Hi, Geezer.
Hi. So earlier you talked about experience in assessing a contractor's worthiness to obtain a bond. And obviously we've been through a couple severe financial crunches over the past decade and a half. So how do you take into consideration the time frame when you look at that experience? In other words, I used to be able to get bonds in many millions of dollars. And then we had a severe financial crisis, and every one of the general contractors with whom I dealt, their businesses, not virtually, literally went to zero.
Wow.
I mean, I was dealing with companies that were doing billions of dollars a year, and they went to zero. So that really affected the financial statements of everybody's company. And now I retired, came out of retirement. I'm mentoring young guys. I have a small business. However, I've got some significant history with large bonds. I still have great credit score, credit worthiness, et cetera. So how do you take into consideration that experience?
Well, probably the same way that we take into account the credit report, right? We're not going to just say, yes, you did this job and check off a bunch of boxes. For surety, it's so much a relationship business that we're going to take into account looking at the financial statements. We know that everybody's, struggling right now, even if it doesn't feel like it. We're in a global pandemic. This is hard. Everything costs more. When we ask for references, the surety company really does call those prior jobs. And we really do ask, how did the contractor do? Because that's really what we want to know. There is going to be a problem on the job. So we're going to ask, how did they handle that problem? Because that is a definition of your character.
Okay, cool.
Geezer, what what business do you represent? I'm not familiar with who you are.
I'm sorry, was that to her or to me?
To you.
No, Geezer. Yeah. What
Oh,
business do you
I'm
represent?
Olympic. I'm Olympic Kitchen and Bath.
Oh, okay.
Thank you.
Thank you.
I should probably change my screen name so everybody can see that. Thank you.
You're welcome.
So I have one last question for you. Again, we're a small business. We did a job for a homeowner, got into a beef with the homeowner because we had a ton of change orders. All those change orders were legitimate. The owner knew about those, but at the end of the job, we weren't getting paid. And the reason given to us was, oh gosh, I'm sorry, it got out of control. It just got away from me. So long story short, we tried to work something out in terms of a payment schedule. The owner couldn't satisfy our needs for that. So we ended up having to file a lien and file a lawsuit. They countersued against our bond, and we're talking about bonds today. So that was reflected on the public information.
Yep.
And people make judgments about that, you know. Anyway, long story short, I said that 10 minutes ago, sorry, but we prevailed in court. We got prejudgment interest. We got every penny we were asking for. We got attorney's fees. We knocked it out of the park.
Awesome.
Their lawsuit, their countersuit was thrown out.
Good.
Okay, but you look into stuff like that because of history. How
Sure.
does that work?
We'll just ask you about it. We
Okay.
know it is really easy. It might even be easier to file a lien than it is to file a claim, but it's really easy to file a claim on a bond. And we're gonna hear you out. If everything else checks out, then it makes sense that whatever your story is that goes along with this also checks out. And most surety companies, most strong surety companies are going to stay on, as long as they have a relationship with you and they know that you're working it out, they're your partner.
Okay, cool. So that won't affect the rates of any future bonds. Okay,
Yeah.
Cool.
It shouldn't. In my experience, it should not. I don't work with your surety company, but in my experience, it absolutely should not.
perfect. Thank you.
The only problem we would have is if the surety paid out and if you, the principal, never paid them back. Then
That makes
then I
perfect
can't-
sense. Yeah,
Then I can't help you out.
yeah.
But like I said earlier, every job has a problem, right? It's just the extent to how that problem is affecting you and how you deal with it. And it sounds like you dealt with it exactly how you needed to deal with it. So in a lot of ways, it actually is a plus, even though it felt like a minus for you going through all of that.
Thank you very much.
Thank you.
Well,
Yes. I had another
Thank you.
hand up. Pauline?
Oh, so are we at time? Yeah, we are. So just very quickly, I have talked to lots of contractors. They say the hurdle that they can't get past is the bond. And if they've not recently done these contracts that are the right size, then, they can't even try to compete. How, and so I know you have to scale up, obviously, but what about if there's a set aside for a certain type of business? And then the other piece of it is, how can, I know there's SBA guaranteed bonds. Is that an option as well?
Yes, absolutely. So 2 questions there. One was the set aside. When you're getting set asides, I'm not a contractor, so I don't know exactly how it works, but from what I understand is I think there's some negotiation in there on those set asides. I don't think it's a good idea for any contractor to jump in size 2 times or more than their largest completed job. So it makes sense for the contractor to negotiate or find set asides that fit within what they can do. Again, we don't want a contractor doing a job that is going to put them out of business. If they can't afford the working capital, if they can't get started on that job, if they don't have the relationships, they don't know how to manage a job that size, it's going to, it's not going to be good for their business. So with the set asides, I would say stick with try to keep it less than 2 times your largest job. And that's going to be, that's just a very rough estimate, but 2 times your largest job is still pretty big, a pretty big jump. So surety companies would prefer to see something smaller.
And
And then you
isn't
asked
it
about the SBA.
within
Oh,
X many years? Isn't it what if you did a whole lot before the recession, but then, you know, isn't it isn't there a timeline?
Well, on the questionnaire, yes, the questionnaire is going to say in the last, I think most of them are at least 3 or 5 years. However, I'm not going to not count something that happened 7 years ago. It's still relevant. Something 7 years ago, if it was 100,000 7 years ago, it's probably a whole lot more right now. So in a way, if you've done a large job even 7 years ago, we might even be able to count that as more. So if your largest completed jobs were longer ago, this is when you need to have a conversation with the surety bond producer as well as the surety company, because it's still experience. And we still need I wholeheartedly believe we need to count that experience. Does that help answer that part of that question?
Thank
And
you.
I know we're 2 minutes over, but I want to really quickly touch on the SBA. So the SBA Surety Bond Guarantee Program works very similar to the SBA for banks, in that the SBA Surety Bond Guarantee Program guarantees a certain portion of the contract to the surety company. So the surety company is more willing to extend surety credit. So what that means is if you've been declined, because I think we have to have a declination in order to go to SBA, it's a lot of extra. If anyone's ever done anything with the federal government, you know there's a tiny bit of extra paperwork involved in that. So there's going to be some more paperwork involved. And there are some classes of business that the SBA might not want to do, but we can work with the SBA if your credit isn't fabulous. If you're looking for a bit of a stretch and the surety companies are declining, this is when we would go to the SBA and ask for help. And if this is specific to anything in particular, I'm happy to talk offline about any particular credit issues, financial issues, that kind of thing. I'm here as a resource for you guys, for you all.
Great. Thank you, Kara.
Of course,
wonderful.
thank you. And reach out to me if you go to any of those websites, you'll find my information. I'm sure all your resources here, PTAC, SBTRC, and EDC. I love all those acronyms. They have my information as well. So reach out to them, and I know they've got resources for you.
So we'd like to thank Kara for this outstanding presentation. And I'd also like to recognize Colleen for getting time to spend with us today, and thank Clallam County Economic Development, Lori Frazio also. I know Amber Dewey was here from the North Peninsula Building Association. And everything that Kara talked about today is actually going to lead into next week's track, which includes Accounting for Construction by Clark Newber, Mr. Peter Miller, and then First Fed Bank, a local bank in Clallam County. And hopefully we'll hear about, some of the SBA aspects of what they're doing. But, you really, Kara really hit it out of the park in regards to covering all the bases. And I have a couple questions that I'll just shoot you an email on.
Of course.
in regards to international. And one thing to note, that if you are doing federal contracting that is somewhere abroad, the rule of thumb is, US rules go, even if you're in, Canada or, London or wherever you might be doing an embassy or something. But because we're so close to Canada, the opportunity for projects right across the border may be something that Kara could assist with any of our small businesses in, working through that and dealing with the banking systems in those areas. So thank you so much. I look forward to having Kara again. She's a pretty awesome speaker. All of her materials are available on our digital Dropbox, which we provided you that link. And if you lost it, send us a quick email and we'll send it to you. So with that, Colleen, do you have any closing words?
Just thank you, everybody, and really appreciate all your expertise and willingly sharing it with us, Kara.
Yes, of course.
Thank you.
And before we sign off, I talked about that WIP work in progress report that's in an Excel spreadsheet, and I might just send that to you if you want to give that to anybody who's interested in taking a look at that and using that format going forward.
That's an excellent idea. Actually, what I'd like to do is put it in our digital drop so that they can access that along with your slideshow.
Perfect. I'll get that to you.
So with that, SBTRC, Andrew Miller, do you have any last minute words for our little gathering today?
Nope, just that the group that is here doesn't necessarily have itself all registered for next week's events, and Wednesday and Thursday next week we'll be doing the second series. So if you are inclined to follow up on this with next week's events, just go back to the registration page and hit the next two. It'll be 8 o'clock on Wednesday and Thursday.
All right, well, thank you. We'll call it a day. We appreciate everybody coming today.
Thank you.
Have a great weekend, and we'll see you next week.